The strength of the Swiss franc, CHF, is a fascinating topic rooted in a unique combination of economic, political, and historical factors. It's not due to one single reason, but rather a powerful confluence of several. Here's a detailed breakdown of why the Swiss franc is so strong and consistently considered a safe haven currency. 1. Political and economic stability, the core foundation. This is the most critical factor. Switzerland has a renowned history of political neutrality. Switzerland's long-standing policy of neutrality, formalized in 1815, means it is less likely to be involved in international conflicts. This makes it a stable base for capital, especially during times of global tension. Strong rule of law, predictable and reliable legal and political institutions create a trustworthy environment for businesses and investors. Low corruption. Switzerland consistently ranks among the least corrupt countries in the world, which fosters confidence in its economy. This stability makes Switzerland and its currency a reliable store of value when other parts of the world are experiencing turmoil. 2. Safe haven status. This is a direct result of the point above. During times of global economic crisis, geopolitical uncertainty, or market volatility, international investors seek safety. They move their money out of risky assets, like stocks in volatile markets, and out of currencies perceived as weak. They look for stable places to park their capital, and Switzerland is a prime destination. This massive inflow of foreign capital increases the demand for the Swiss franc. Basic economics, increased demand for a currency, with supply remaining relatively stable, drives its price, exchange rate, up. Events like the 2008 financial crisis, the Eurozone debt crisis, and recent global conflicts have all seen massive flows into the CHF, strengthening it. 3. Sound fiscal management and low inflation. Budget discipline. The Swiss government is known for its fiscal responsibility. It has very low levels of public debt compared to other major economies. Low inflation. The Swiss National Bank, SNB, has a strong mandate to ensure price stability. Switzerland has maintained very low and stable inflation rates for decades. A currency that holds its value over time is inherently attractive. 4. The role of the Swiss National Bank, SNB. The SNB plays a unique and active role in managing the franc's value. Ironically, they have historically tried to prevent the franc from becoming too strong because it hurts Swiss exporters. Their goods become more expensive for foreign buyers. Foreign currency interventions. The SNB has been known to create francs and use them to buy massive amounts of foreign currencies, like euros and USD, to increase the supply of francs and weaken its value. Negative interest rates. For years, the SNB imposed negative interest rates. This meant commercial banks had to pay to park their money with the SNB. The goal was to discourage investors from buying francs solely for interest yield, making it less attractive to hold and thus weakening it. 5. A massive current account surplus. Switzerland consistently runs a very large current account surplus. This means the value of its exports, goods, services, especially financial services, is much higher than the value of its imports. Exports. Switzerland is home to global giants in pharmaceuticals, Novartis, Roche, manufacturing, ABB, Schindler, luxury goods, Rolex, Swatch, and food, Nestlé. These companies generate huge foreign revenue, which must be converted back into francs, creating constant demand. Financial services. Switzerland is a global wealth management hub. Managing foreign assets generates substantial service export income. Tourism. While also an import, tourism brings a significant amount of foreign currency into the country. This structural surplus means there is always a natural, underlying demand for CHF in the global marketplace. 6. The banking secrecy legacy. While much weakened due to international pressure and agreements on tax transparency, Switzerland's history as an ultra-secure, discreet banking haven built a reputation that persists. It created a deep, lasting trust in the Swiss financial system that continues to attract capital. 7. The challenge of a strong franc. It's important to note that this strength is a double-edged sword. Harms exporters. Swiss companies like Nestlé or Roche find their products become more expensive for overseas customers, potentially losing market share. Hurts tourism. Switzerland becomes a more expensive destination for foreign tourists. Dampens inflation. A strong franc makes imports cheaper, which can lead to deflationary pressures.
which the SNB also tries to avoid.